We'll continue our discussion on dividend discount model. It should be used primarily for stable companies with a history of profit. And this profit history, as well as future expectation, should be linked with dividend policy of a company. Plus, we also said that it's for non-controlling interest of shareholders. That is, shareholders do not have access or influence over the policy of dividend, whether it should be increase or decrease. And then we also discussed about one-year dividend discount model. Dividend in 1 year plus price, and 1 year divided by 1 plus R, raised to 1. So this gives us the discounted price at today's date. This is value at today's date, and before we actually move into the multi, let's try and solve one basic question to test our understanding on where the dividend discount model should be used. In this we have two companies, one is ABC, the other is XYZ. We see that we are given earning per share. We are also given dividend per share, and then we have the payout ratio. Payout ratio is basically dividend per share divided by earnings per share. So what we need to look into is whether the dividend discount model is appropriate for ABC or XYZ. Basically look into that the dividend policy of a company should have a direct bearing on the profitability. There shouldn't be any year when we are not declaring any dividend. The next year there is a huge dividend, and the next year there is no dividend, and so on. There should be stability with respect to the payout ratio that is to do with the dividend policy. So we see that under ABC the earning per share is varying across all the years. Our dividend per share is stable. So do we really apply dividend discount model here? Well, the answer would be no. The reason is we are having a stable dividend per share, but our payout ratio each year is changing drastically. 1 year we are paying 244%. The other year, it's 833%. That is 8 times the next year. We not even declaring any dividend, or it's not meaningful, and so on. So there is no stability with respect to dividend payout ratio. So our dividend discount model is not suitable in this case. Now we move to XYZ Corp, in which we see the same information, and we also see that payout ratio is relatively stable. We see that minimum we have is 29%, and the maximum we have is 58%. Which is quite stable. So in this we use dividend discount model, so it's more appropriate in case of XYZ. Let's discuss the multi-dividend discount model. It's very similar to one-period dividend discount model, it's just that, instead of looking at just one period, we are looking into multi-period. That is dividend in first year, second year, and so on, and this is the 9th year, the last year, and basically what is happening is we are discounting dividend on each of the next years till nth year. And then we are applying this formula, which is nothing but this part. We are adding the last year as well. So we are applying basically 1 year model, but in one period we are just looking into from 0 to 1. In this we are looking into 0 to 1 to 2 to 3 and 4 and so on till nth year. And accordingly we're discounting all the dividends in year 1, year 2, year 3, and the last is same. What is the price we expect at 9th year? And then we discount that as well. The dividend discount model in our multi-framework through an example. In this, what we have given is suppose there is a stock which is expected to trade at $15 2 years from now. Recently, it has paid a dividend of 1.5 and investors' required rate of return is 12%. Calculate the value of this stock. As of now, the dividend is expected to grow at 5% per year. Let's say from a time point of view this is 0. These are years, and what we are given is dividend. In current time is 1.5. And it says that it grows by 5%. So what we do here is this is the dividend and we grow it by 1 plus 5%. It gives us 1.58, and what happens in the second year is the first year dividend will again grow at 5%, and we have 1.65. So these are the future values of these dividends. What we need to do is we need to get down to the present value. But before that we need to also look into the price. After 2 years, we are given that it will be 15. So now what we need to do is we need to arrive at present values. So present value of stock we need to find, so we can just equate it here, and we need to also find present value of dividend. Our rate is given as 12%, and we need to discount it. Be the second year discount rate. So it is 11.96. And we need to similarly discount the dividends as well. So this is the first year dividend we discounted by 1 plus rate, raised to the power of 1. And we apply it to our second year as well, so it's 1.32. Our present value will be just an addition, so we just sum it up. What we get here is 2.72. We need to add these both in order to arrive at the current value, or the intrinsic value. We get approximately $14.7. So let me just write down few formulas we used here. Dividend discount, dividends, in the current year. So dividend is multiplied by 1 plus the growth rate in dividend, and each year it's growing by 5%. So had it been 3 or 4 years, we would have just multiplied it by 1.05 and drag it further. So this is about the growth of dividends. Since this is the future value, we need to arrive at a present value of the dividend as well as stock. We are giving that after 2 years the stock price is expected to be 15. We need to just discount it. Whatever is the future value, we just divided by 1 plus r, that is the required rate raised to the power 2. So 14.7 approximately as is the intrinsic value of the stock. The first step for multi-dividend discount model is to arrive at a future dividend. And how do we do that? We just multiply. D1 would be D0*1 plus the growth rate. In dividend we get D1. Similarly, D2 would be D1 by 1 plus growth. Or we can take D0*1 plus growth rate raised to 2. So either way it will give you the same answer. So you can use either of these two. The second step we take here is we are usually given the future price of stock. Future price of stock. So this would be, I would actually say this is just the first step. You calculate future dividend and you're given future stock. The second step would be arriving at the present value of dividend and the stock. This value, for example, we are given D1, D2. So we just take D1/1 plus are raised to 1 and D2/1 plus are raised to 2. This is the present value of dividends. Similarly, we arrive at present value of stock. By the second year, we get present value of dividend and present value of stock. The third step is basically just add these two values. Just add these two values. That is the present value of dividend and present value of stock in order to get the true value. So these are basically 3 steps. First is future dividend, future stock price you discounted by the required rate in order to get present value of dividend and discount stock price. The third step is just simply adding this present value of dividend and stock. This is multi-dividend discount model.